What if the United States defaults on its debt? Will it cause the next Great Depression and implode the world economy? Right now, there's a titanic battle going on in Washington with the debt ceiling, and we have Janet Yellen, the Treasury Secretary, insisting that every responsible member of Congress must agree to raise the debt ceiling. And there's a very good reason to be afraid. If the United States really stops paying their bondholders and defaults, this will spell doom not just for America but the global economy. We even have the CEO of Bank of America preparing for potential US debt default. And this is really serious stuff. Now, I want to be clear that this isn't a doomsday prophecy, it's a worst case scenario of what might happen if a debt default does go through. And it doesn't matter if it's a technical default where interest payments stop or if it's a debt jubilee where the US government declares their own debt forgiven, right? If the debt isn't honored or paid back, the fallout could be tremendous and hyperinflation might actually happen in the United States. So what happens after the US defaults? Now, a lot of us, we believe that the dollar will crater and gold will spike to 20 grand instantly, right? But in fact, we could actually see the dollar strengthen in the short term. Let me explain, guys. Now, the problem with the world economy today is that almost every country, with the exception of Russia, is centered around the US economy and the dollar. In other words, the world is still incredibly dollarized, right? Even China still relies heavily on the dollar. Now, almost 60% of central bank reserves are in US dollars, and 60% of trade is still invoiced in dollars. But the big one, the huge time bomb, is the amount of global debt that's denominated in US dollars. Over 60% of global debt is issued in a greenback. And if the US suddenly defaults and says, sorry guys, we screwed up and we don't have the money to pay you. Now, this immediate fallout will be a shortage of US dollars because the system is set up for the reserve currency to flow around the world, not just in the United States. Because if a default happens, it will trigger one of two things, right? Either the principal or the debt will vanish and disappear, or the interest payments suddenly stop. And if we look at the global treasury market, it is around $24 trillion strong, and foreign treasury holdings are already at $7.2 trillion, with Japan, China, and the UK holding the most. So let's just assume that the US just screws the foreign bond holders and defaults just there. Now, suddenly, there'll be a shortage of dollars going around, and countries will no longer receive the interest payments on their US bonds. And we know what this leads to: a currency crisis. There'll be a massive selling of local currencies to get whatever dollars are left because you still need to import goods and commodities. Plus, you need to fulfill your own dollar denominated debt. That's how crazy things can get. Many foreign countries still operate on the dollar system, and this is called the euro dollar market. Many banks in Europe and Asia transact, borrow, and lend money in US dollars. So, if you hold US dollars and deposited it outside of the United States, you have euro dollars. You're part of the euro dollar market. So, in essence, the euro dollar market and their need for US dollars will keep the dollar system propped up immediately after a debt default. But make no mistakes, guys, this will be temporary because geopolitically, a default will piss off the world, right? Not only will foreign bondholders see their treasury values crater to hell, but they might also experience their own default as well if they can't get enough dollars. Now, this is what's crazy. The Bank of International Settlements estimate there's over 80 trillion of hidden dollar debt floating around in the system. That is a ticking derivative time bomb because it exceeds the stocks of treasury bills, repo, and commercial paper combined. So if a default happens, treasury values will collapse, and this in turn could explode the debt bomb in the shadow banking system. He'll be on a scale beyond the '08 and Lehman Brothers collapse. Now, once the collapse happens, or maybe even before the global bond implosion, we could start to see the great unwinding of dollar-denominated debt, and this is key. And let's call this the great unwinding or the great escape, right? Countries, central banks, and even companies will start to reduce or even stop issuing dollar-denominated debt because what's the point? At this point, the dollars will be fluctuating wildly against foreign currencies, and you have no idea how much you will lose on the exchange rate when your bond eventually matures. The point of issuing debt in dollars is because of its reserve status. You want stability and to remove exchange risk. Investors, they love US dollar bonds because they believe it is rock solid. But if the stability is removed, then what's the point? If the US Treasury themselves can't honor their debt, where are you going to get the dollars to repay your own debt, right? And even if you could, After 5 or 10 years, the dollars you hold will be devalued against your own currency. And the danger is the entire euro dollar market that no one is talking about. Now, for a lot of us, we are just focused on the petrodollar and how the Saudis they are pricing their oil in dollars. Now, this is important 100%. If a default happens, it is obvious that Saudi Arabia and OPEC will start to unwind itself and move away from dollars, right? Maybe they will accept the yuan, or maybe they no longer trust any currency and they only accept gold. Now, back in the 1970s, Saudi Arabia actually exchanged between 10 to 12 barrels of oil for 1 ounce of gold. And this could happen again because once trust is lost, it could be lost forever. Now, just the words fiat currency might give the Middle East a nightmare. What's the point in accepting fiat currencies that could default when we could have gold? But let's focus back on the euro dollar market for a bit. According to the American economist Robert Murphy, trade in the euro dollar is enormous. We are talking about 12 trillion euro dollars floating around, while all dollar assets in the US banks total only around 22 trillion. Now, in contrast, the petrodollar trade is less than $3.5 trillion annually, so the euro dollar market is a much bigger contributor to the de-dollarization game if it happens. So just imagine if a third of the total dollars in the world begins to stop circulating around. Countries will be afraid of pricing stuff in dollars or issuing dollar denominated bonds because now the reserve currency is in free fall versus other currencies. And guess where all these dollars are going to flow? They're going to flow back into America and tangible goods. Then we will really see inflation take off, right? So I hope you can see the deadly chain of events that could happen, how the domino effect will first destroy the world economy, leaving a trail of destruction and currency crisis before the tsunami comes for the American economy. And this is going to be a horror story, and you quickly realize why defaulting is not a very good idea. And we will see a huge pile of dollars suddenly rush towards tangible goods and commodities. And this is where the reserve currency status works against the dollar, not for the dollar, but against it. Because everything is priced in dollars, holders will likely cram into the exits and start exchanging the greenback for tangible stuff. We're talking about oil, gas, gold, silver, and copper. And this is going to beat up prices in the global commodities, right? The dollar will become a hot potato and everyone will be passing it around. Its value will be cratering against real assets as well. Now, even the Federal Reserve has been tracking how much purchasing power the dollar has lost. It's down almost 97% over the last 100 years. And if America defaults on their debt, the remaining 3% is going to bleed away. But the worst is yet to come. Now, just imagine all these dollars being held by the commodity giants, central banks, and whoever's left. They will scramble to get rid of the dollars and it will come flooding back to the United States. Foreign dollars will be on a hunt for tangible goods. We're talking about real estate, farmland, and maybe even American companies, right? So, in essence, there will be capital flows back into the US, but for all the wrong reasons. It's not because the state of the economy is strong, but dollar holders want something tangible for their paper currency now. And let's travel back to the 1920s in Weimar, Germany, when the German mark was hyperinflating away. And according to JP Morgan, the German stock market also increased in nominal terms, flying up multiple times based on German marks. But if you measure it in terms of US dollars back then, it was very volatile and even fell towards the tail end. And this tells us that when money dies, everyone holding the currency will turn into speculators and start bidding everything up, right? Doesn't matter if it's stocks, real estate, or gold, money is going to flee cash and is burning up into assets. And here's the interesting thing, right? If we chart the German stock market against the US dollar from 1918, it actually fell in value. And remember that the dollar was pegged to gold back then, which means the hyperinflated stock market fell in value versus the tangible store of value like gold. And it's really something to think about. So if a default happens, inflation is going to soar in the United States. Food is going to rise, rents are going to soar, groceries are going to go through the roof. Now, the default will start in the foreign currency markets first, then the panic could spread towards the US domestic markets next. And when local Americans they see foreigners bidding up prices back home, they will likely join in the fervor. They will start getting rid of their dollars for tangible stuff as well. Now, eventually, the panic will subside. Hyperinflation in Germany didn't last forever, and even if it happens in the United States, I expect America to recover much quicker. But because the US defaulted on its debts, bondholders are now terrified of lending the US government money at such low rates, right? However, there'll still be cowboys around ready to loan money to America, but it will be at a much higher interest rate, right? Maybe even double digit yields. Now, remember back in the 80s, yields went as high as 15% during the Volcker era, so this isn't exactly impossible. And this is going to slow down the entire US economy and slow down the recovery of the stock market. Even after hyperinflation is over and things restabilize, we could see the S&P grow at a much slower rate than 10% a year, like in the good old days, right? Higher rates will force down government spending because it will be insane to go back to deficit spending. I mean, they could always print up new money, but let's just assume they don't. And what does this mean? Federal programs like Social Security will have to be reduced. We already have the Congressional Budget Office releasing disturbing projections showing Social Security reserves could crash to zero by 2033. And this is even before any talk of a debt default. And in fact, according to the White House, over 50 million Americans are on food stamps and housing assistance alone, all financed by government spending. So if new debt is extremely expensive, the only alternative now is to either cut down on spending or raise new taxes. So I really want to emphasize how bad things can get for the world if a default happens. It will cause chaos outside of the US before the problems start rushing back to American shores. And it doesn't matter how many trillion-dollar platinum coins they decide to mint, which is a terrible idea, by the way. The bond market is all about trust, and yields are a reflection of how much the world trusts the solvency of the US government. Whether it's a debt jubilee, a trillion-dollar coin, or a debt default, or Santa Claus, it all affects the trust of bondholders, and that in turn affects bond yields. But things get even spicier if a default happens, because this is playing directly into the hands of the BRICS nations, especially China. And we know by now that China and Russia wants to de-dollarize the world. The Chinese wants to push the yuan as a reserve currency, and a debt default is going to make it much easier. And at this point, all they need to do is to back up the yuan with gold, and the rest of the world might actually bite. They could take the bait of a gold-backed currency because now everyone is afraid of the dollar, fiat currencies, and especially US treasuries. A US debt default is the equivalent of the sky falling down in the financial markets. And now let's sit back and think about how America could avoid a debt default. Now, the most obvious solution is to cut down on government spending and just rely on revenues to run the country. This is the most prudent solution, and it can be done. We can see that right now, deficit spending is still not the majority of total government spending. In 2022, the deficit of 1.38 trillion only accounted for 22% of the total budget. So cutbacks, at least on paper, are still theoretically possible. But let's talk about the gold revaluation, guys. This is the most interesting one. Now, a lot of us in the gold community, we believe that America could suddenly revalue their gold to over 10,000, 20,000, or even $50,000 an ounce, right? For example, to account for the deficit. However, there's a big problem. You can't just revalue gold like that. You need the rest of the world to agree, and that means getting the biggest gold producers like China and Russia to agree to reprice gold. And the big problem is, will they agree? Will they help to bail out the United States, or will they refuse to peg gold at a higher price in order to force a default? We really don't know. Even the Federal Reserve understands they can't go back to a gold standard because if they do, and in their own words, the bigger suppliers of gold would have more control over our monetary policy. And that's why the most obvious solution is to burn the debt away. And this is exactly what Lynn Alden also believes is the simplest solution. The Federal Reserve can hold interest rates below the inflation rate for a prolonged period of time, let inflation run hot, and burn the debt away. And this way, interest rates will be near zero again, and interest payments will come down because the federal revenues will increase in terms of inflated dollars. And here's the crazy part. Even if bond yields are suppressed by the Fed again to near zero, there still will be demand for US bonds. Now, back in 2020, bond yields on the 10-year fell below 1%. People were buying not just because of the lockdowns, but because dollars were needed for trade and to pay back their own dollar-denominated debt back home. However, if the Federal Reserve goes into the market, does QE again and buys up all the bonds to push down yields, this will cause another wave of inflation sooner or later. Yes, they could stop a debt default, but it will be at the expense of the US dollar. the purchasing power of the dollar will evaporate further. So let's understand how dangerous a debt default will be for the world, right? In the short term, we could see further currency crisis and the dollar could even rise. But this is going to come back and destroy the petrodollar system and cause chaos in the euro dollar market. A debt default doesn't just affect domestic American dollars, but the global supply of dollars floating around Europe, Asia, and the rest of the world. And that's why I'm very confident that Congress will not allow a default to happen right now. They will likely raise the debt ceiling and allow this game to continue. But this is still a big concern. According to the Peterson Foundation, the net interest cost of the national debt is growing. It is projected to hit over $1.2 trillion annually by 2032, which is an insane amount. And by 2052, it will account for almost 40% of federal revenues. And what if it goes above 50% or more? Will the US be forced to default sooner or later? And that's why having this conversation is so important. There's only so much you can borrow even as a country. Now, reversing this is definitely possible. And that's why I believe having a debt ceiling is still important. It shouldn't be abolished because it is an important reminder that the time bomb is still ticking away. So bookmark this video because if a default happens, this might be the end game. This doomsday scenario might come true. But let me know what you think. How bad can a debt default get? Will the US raise the debt ceiling once again? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.